Hello and welcome back to Game of Trades, your #1 channel for videos on the stock market and cryptocurrencies. This video is going to be focused on the SP 500. We have so much to cover in this episode. A lot of things are changing very, very quickly on the charts, on the macro. And these are really the moments where we have to be as precise as possible in our decision making, not let emotions get in the way of rational decision making. We still have the stock market investor sentiment at historic lows. Just a huge amount of bearish investors in the market right now, expecting the markets to be down 6 months from now. If you compare that to history, we've rarely had these types of sentiment readings. I believe the last cluster similar to the one we've had throughout 2022 was in 1990 at the bottom of this recession. Now, that doesn't mean the exact same thing's going to happen now, but that's just to give you an idea, to put this information into context. Investors are very often bearish at bottoms. In fact, you could see that in the last episode, the markets were trading at around 3,900 points. When we posted the video, you could feel in the comment section, people are fearful. Investors are very fearful and very uncertain about the future. So we're going to talk about all that. We're going to dig into the data, what we should be expecting in the short term and the intermediate term. We're going to touch on our bullish macro thesis on the market. As I said, we have a lot to cover in this episode, so make sure to listen very carefully. If you are new here and you're interested in following these crazy markets with us, do not forget to smash that subscribe button. If you enjoy this episode, don't forget to click on that like button. And now, without further ado, let's get right into it. Now, the first thing that I want to talk about is the stock market breadth, and more specifically, the NASDAQ 100's market breadth. Right, this is an indicator we often take a look at. It's the number of stocks above their 200-day moving average. So it tells you how broad the participation is in a rally. When you've got all the stocks trending above their 200-day moving average, this indicator is very elevated. And when the market is very oversold and all stocks are trending down, that's when this indicator is very low. Now, why am I showing you this? Because you can see here, I have one line drawn on this chart, and that's the 15% level, and we tagged it at the end of last week. Now, if we take a look at this article that we posted on our website at gameoftrades.net on the 25th of April, you can see we talk about this very indicator here, the NASDAQ 100 stocks above their 200-day moving average, and you can see it was pretty elevated here, or at least a lot more elevated than that 15% level. And we said in that article, if we scroll down a little bit, if the indicator reaches 15%, we'll switch our short-term rating on the S&P 500 from a hold to a buy. And so that's exactly what we did. As it hit that 15% level, our short-term ratings on the tech sector switched to a buy for the short term at least. And that's just because of the probability of this level. Nothing is 100% in the market. It's all about data. It's all about statistics. And when you have that type of level where you've got so many important reactions off that key 15% level, you can see it marks systematically very important bottoms in the stock market, or at least on the NASDAQ 100. It tells you that the tech sector is oversold here. It's an oversold reading that's leading to a counter trend rally right now. And if we add the NASDAQ 100 on this chart, you can see it doesn't get any better than this. You don't get better timing indicators than this type of reading. I found that these types of charts, these types of indicators are really what give you so much more of an edge on other market participants. Now, we've been bullish on the market for quite some time now and expecting higher highs, but we've only had 2 buy ratings in the short term. One back here in March 2022 and one right here in May 2022. So although you can be wrong about your thesis, about your bullish thesis, if you use these types of indicators to help you have that extra edge, to find high probability entries in the market, you're going to be entering the market at exceptional risk reward opportunities. And this is exactly why being in the market is so difficult. It's not rocket science. It looks easy like this. It tags the 15% level and you get a bounce, or at the very least, you get a bull trap. Things look horrible at bottoms, and you really need to go against that gut feeling. Everything's in the red, all stocks are trending down, and it feels scary to be bullish in this type of market. And believe me, I know exactly what that feels like. I started out not knowing a thing about the market, not knowing how to make money in the market. There's no university course that tells you how to be profitable in the market. It's about experience, and it's about paying attention to the right data. That's exactly why I started gameoftrades.net. There's just a tremendous amount of people that are trying to manage their own portfolios, and that's absolutely amazing. But you go online and there's an absolute lack of quality research and just too much disinformation out there. So what we're trying to do in these articles and this research that we put out is prevent you from making the same mistakes that we've made and give you that extra edge on the market. So if you're interested in joining our community and taking a look at our trades, our opportunities, our convictions on the market, make sure to check out gameoftrades.net. So we've established that the market is oversold here. We're due for a bounce. The question is, and this is exactly what we're going to try and figure out over the next few trading sessions, whether this correction that we're seeing could have another buying opportunity. And I do want to say buying opportunity because I think ultimately once this is over, we're going to see a much larger period of bullish momentum on the market. So we're going to be watching the VIX very closely as it gets closer and closer to that line of support. Now remember what this line of support is. This is a line that goes back to November 2021, which is essentially the top of the market. We saw volatility, so the VIX of the SP 500 rise over the past few months and bounce along that trend line here. This has really been a fascinating tool to use to time these bottoms and these tops in volatility because the VIX continues to be a perfect bottom timing indicator for the S&P 500. Let me just add the S&P here, this trend line here that goes back to the COVID high of the volatility. Ever since we had this reaction here, we drew that trend line and we've used this as a line of resistance. And we had one reaction back in March and one reaction back here in May. And since then, volatility has been coming down. So the closer we get to that line of support, the less attractive it becomes to buy the S&P 500, right? So as we see this bounce, we're going to see the volatility decline, and we're going to be very cautious here, all right? We want to buy when the VIX is elevated. Now, what indicators are we going to use to evaluate whether or not we can actually expect volatility to break down? And that type of scenario would create a massive run on the S&P 500 as we see volatility decline in a big way. For that, we're closely paying attention to the bond market, to the 10-year yield. We want to see bond yields roll over here. This move here in the 10-year yield has put a tremendous amount of pressure on the equity markets. Let me show you that on this chart. Now, we've been covering this the entire time. Yields have spiked, and that's led this S&P 500 decline as we've seen tech absolutely get wrecked in response to those rising yields. Now, that's partly what led us to expect a bottom a lot sooner because I didn't expect this final rise in the 10-year, right? This final spike that we've had throughout the end of March and throughout the month of April. The 10-year went a lot further than what I initially expected. So we need to see this roll over if we want the rally to really have a chance at getting going much further up than just a nice counter trend rally, which is what we're expecting at the very least right now. And by the way, that's as we are testing this massive line of resistance on the 10-year. So we're very overextended relative to trend on the 10-year. So the big macro factor that's been pushing down equities, I think we're going to see some of that pressure, some of that headwind that we've had be relieved. Because I do think you're going to see selling pressure off this line of resistance over the past 20, 30 years. We've seen this act as a very powerful level of resistance, and you combine that with the extreme overextension of bond yields right now, it's pretty likely we're going to get some type of a reversal here, and that would be bullish for the market. So we're going to be watching that very closely on the website at gameoftrades.net and continually reevaluate whether we're on the right side of this trade. We're going to be actively taking a look at these developments and see how we can expect that those developments are going to materialize in the equity markets. So if you're interested in keeping up to date on that research, make sure to click on the link down below and sign up to our service at gameoftrades.net. Now, that's about all I wanted to cover in this episode. I hope you guys enjoyed. If you did, make sure to drop a like and subscribe to the channel if you haven't already. Now, in the meantime, I wish you good luck on your trading and see you next time.